There once lived a man who cracked the code of the stock market, not through Wall Street connections, not through elite financial training, but through something far more unexpected. He was not a banker, not a broker, not even a trader by profession. His life began on theater stages, under the glare of spotlights, dancing alongside Hollywood stars. Yet when the curtain fell, he quietly built a fortune worth millions. How did a dancer achieve what so many trained financiers failed to do? This is the remarkable tale of Nicolas Darvas. Nicolas Darvas was born in Hungary in 1920 and trained as an economist at the University of Budapest. But destiny had other plans. In 1943, as political unrest shook his homeland, Darvas escaped with a forged exit visa and just 50 pounds in his pocket. With nothing but courage, he fled into the unknown, eventually reuniting with his half-sister Julia. Together they formed a dazzling dance duo, performing across Europe and the United States. Their hard work paid off. By the early 1950s, the Darvas siblings were gracing stages alongside legends like Judy Garland and Bob Hope. On stage, Nicolas Darvas lived the life of a performer, but off stage, in hotel rooms and between shows, he began to obsess over something entirely different: the stock market. Darvas was no casual dabbler. He devoured the subject with the same intensity he devoted to perfecting his dance routines. In his downtime, he buried himself in more than 200 books on investing, sometimes studying up to 8 hours a day. His reading list included The ABC of Investing and the works of Gerald M. Loeb and Humphrey Bancroft Neal. These authors profoundly shaped his thinking, teaching him that markets were less about numbers on a page and more about psychology, patterns, and discipline. Though he had no financial mentors, Darvas trained himself like a scholar, piecing together theories and lessons until he felt ready to step into the market himself. Darvas's first big opportunity came not from Wall Street, but from a stage contract. Unable to attend a performance, he was offered 6,000 shares of a Canadian mining company, Brilliant, as partial payment. Instead of dismissing it, he invested $3,000, buying at 50 cents per share. 2 months later, he opened a newspaper and nearly dropped it. Brilliant had climbed to $1.90 per share. Darvas sold and walked away with an $8,000 profit. For a man who had once escaped his country with only 50 pounds, this was intoxicating. That early win convinced him he could master the market, but success would not come so easily again. Flushed with confidence, Darvas dove deeper into trading. He followed tips from friends, listened to brokers, and tried new strategies. Some trades soared, filling him with exhilaration and control. Others collapsed, leaving him frustrated and searching for someone to blame. The problem was not intelligence. Darvas was brilliant. The problem was consistency. His profits vanished as quickly as they appeared, eaten away by frequent trading and hefty commissions. He became addicted to daily action, constantly buying and selling, chasing the next opportunity. But the harder he chased, the faster success slipped away. Then something unexpected happened that changed his perspective entirely. Darvas purchased 100 shares of Virginia Railways at $29.75 each. Unlike his usual habit of constant monitoring, he let the stock sit quietly for 11 months. When he finally looked again, the price had climbed to $43.50. Selling his shares, he pocketed a clean profit of $1,303.68, without stress, without daily trading. This moment hit him like a revelation. Sometimes the best move was not to move at all. Patience, he realized, was a weapon. From this, Darvas crafted his 7th trading rule: let your investments grow and do not interfere unnecessarily. This was the beginning of the disciplined trader he would become. As Darvas refined his methods, he began to notice patterns in stock prices. Strong companies with upward momentum often moved in steps, trading within a defined range, then breaking out higher into a new range, and so on. He visualized these steps as boxes. Thus was born the famous box theory. Whenever a stock formed a box, a stable trading range, Darvas waited. If the stock broke upward out of the box, he bought in. If it dropped, he cut his losses immediately with a stop-loss order. This method gave him structure, discipline, and, most importantly, protection against devastating losses. Touring with his dance troupe, Darvas relied on Barron's magazine, even though its data came with delays. Still, the method worked. He hunted for momentum stocks, focused only on those with strength, and never entered without a stop-loss in place. By sticking to his box theory during the bull market of 1957-1958, Darvas achieved what seemed impossible. In just 18 months, he turned his strategy into a staggering fortune of $2.4 million. At age 39, the dancer who once studied books in his hotel room was featured in Time magazine as a market wizard. His story seemed almost unbelievable until he wrote it down himself: how he made $2 million. In 1960, Darvas published his now classic book, How I Made $2 Million in the Stock Market. With simple honesty, he documented his journey, the mistakes, the rules, the box theory, and the lessons of discipline and patience. The book became a sensation, inspiring countless ordinary investors who, like Darvas, had no Wall Street pedigree but dreamed of success. He showed that the market was not reserved for insiders. It was a game of discipline, psychology, and courage. But not everyone celebrated Darvas. The New York Attorney General accused him of exaggerating his financial claims, launching the first legal action under a new law against fraudulent investment advice. Darvas fought back, calling it a misguided attack. Eventually, the courts sided with him, blocking further investigation as an infringement on freedom of the press. Though he emerged victorious, the episode highlighted how unusual and disruptive his story was to the financial establishment. Darvas's brilliance did not stop with stocks. He dabbled in fashion, theatrical production, and real estate, proving his belief that success followed universal principles. If you mastered discipline, patience, and strategy, you could succeed in any field. Interestingly, Darvas avoided short selling. He admitted it clashed with his psychology. Betting on failure never suited him. Yet he acknowledged that in changing markets, experienced traders might need to adapt. Still, he cautioned that conservative investors should avoid it. Nicolas Darvas passed away in 1977, but his legacy remains. His box theory, though criticized by some as a product of a bull market, introduced principles that became staples of modern trading: trailing stop losses, momentum analysis, and above all, discipline. Critics argue that his fortune owed more to timing than genius, but even they admit that his greatest contribution was not a formula, it was a mindset. Darvas taught traders to keep records, analyze results, and stick to a plan. He showed that emotional control was just as critical as technical knowledge. From a refugee dancer to a millionaire trader, his life proved that success can come from the unlikeliest of places. With curiosity, persistence, and discipline, anyone could aspire to achieve what he did. Nicolas Darvas's story is not just about money. It is about resilience, reinvention, and daring to walk a path no one expected. From escaping war-torn Hungary with nothing, to dazzling audiences worldwide, to cracking the stock market with his self-taught strategies, Darvas lived a life that continues to inspire. Even today, when traders set stop-loss orders, track momentum, or remind themselves to be patient, they are unknowingly echoing the lessons of a man who once danced across the world's stages and quietly outsmarted Wall Street. Even today, when traders set stop-loss orders, track momentum, or remind themselves to be patient, they are unknowingly echoing the lessons of a man who once danced across the world's stages and quietly outsmarted Wall Street.